Buy and hold great businesses forever. That's Warren Buffett's most famous line, the gospel of passive investing, the mantra parroted by every financial advisor, fire blog, and TikTok finance bro for the last 2 decades. But here's what they didn't tell you. While Buffett was telling you to hold, he was selling, quietly, relentlessly, for 12 straight quarters. And today, Berkshire Hathaway is sitting on $382 billion in cash. That's not a typo. It's the biggest corporate cash pile in history, bigger than the GDP of Austria, Denmark, or Singapore. What's missing from your portfolio is the thing Buffett is holding most, and it gets worse. He sold 67% of Apple, the stock he once called the best business I know. He sold his banks, his Japan positions. He moved out before the 2025 crash and never came back. And here's the punchline. Buffett retired on January 1st, 2026, left the table with $382 billion in chips, and left you holding the drawdown. So the question isn't what would Buffett do? It's why did Buffett say one thing and do the opposite? Let's look at the filings, follow the money, and expose the contradiction hiding behind the quote. For decades, Warren Buffett was the North Star of long-term investing. He told millions of people to ignore the noise. He said market timing was a fool's game. He swore by holding great businesses through every cycle, and no company symbolized that belief more than Apple. In 2020, he called Apple the best business I know. By 2022, it was over 40% of Berkshire's portfolio. He said he'd never sell it, that it was his third business after insurance and railroads. Meanwhile, in every shareholder letter, every CNBC interview, every financial book quoting Buffett, the message was simple: buy, hold, don't time the market, be fearful when others are greedy, be greedy when others are fearful. But while you were holding the bag, Buffett was getting out. Between 2021 and 2025, Berkshire reduced its equity exposure every quarter. Not once, not temporarily, every single quarter. Banks gone. Apple trimmed. Japan trading houses out. New buys none. And the cash, it piled up until it hit $382 billion by the end of 2025. And then, right as markets stumbled in Q1 2025, Buffett retired. No warning, no big announcement. He just left the game with the chips in his pocket. This wasn't a market prediction. It was a contradiction, because while he was telling you to hold through the dip, he was already out, and that disconnect. It wasn't an accident. It was a strategy. Coming up, we'll line up every quote against every filing. You'll see the timeline, the cash buildup, the exits, and you'll see how Buffett played one game while the public played another. Let's walk through what Buffett actually did quarter by quarter versus what he said, because the math doesn't lie. The filings are public, and once you lay them out next to each other, the contradiction is impossible to ignore. We start in Q1 2021. Buffett is on CNBC telling viewers the best holding period is forever. At the same time, Berkshire S13F shows the first major trimming of Wells Fargo, a position he held for over 30 years. Q2 2021. He praises Apple in his shareholder letter. It's probably the best business I know. Behind the scenes, Berkshire trims 3% of its Apple stake. Subtle, not alarming, but the pattern starts. Q for 2021. Quote, I don't worry about short-term swings. If it's a good business, I don't sell it. Filing, 6% of Apple is sold. His JP Morgan position cut by over half. Q2 2022. Buffett tells a Nebraska crowd, we are not market timers, but in the filings. Goldman Sachs is gone. PNC Financial gone. Citigroup reduced. By the end of 2022, Berkshire had trimmed over $25 billion in bank stocks, and his cash position pushed past $150 billion for the first time. Now here's where it gets serious. 2023. Markets are choppy. Tech stocks bounce back after 2022's bloodbath. Everyone's screaming new bull market. Buffett stays quiet, but his 13F says plenty. Sold down Apple by another 10%. Exited Japanese trading houses, reduced Bank of America, and pushed Berkshire's cash to $248 billion. Meanwhile, retail investors still loading up, still dollar cost averaging into the S&P 500, still clinging to buy and hold, because Buffett told them to. 2024. The S&P hits new highs. Meme stocks run again. Bitcoin's back. Buffett finally speaks, saying markets are frothy, but we stick to fundamentals. That quarter, Berkshire trims another 14% of Apple, cuts Chevron, and unloads the last of U.S. Bancorp. Cash now at $325 billion. And here's the punch. Q1 2025, the S&P drops 18%. Apple corrects 21%. Regional banks stumble again. Retail investors panic. Buffett, already out. By the end of 2025, Berkshire holds just 1/3 of its original Apple stake. All banks are gone. No new major buys. Cash tops $382 billion. And Buffett retires quietly, with a smile. No warning, no speech, just done. Because the real story isn't that Buffett called the crash. It's that he prepared for it while telling you not to. And next, we'll do the math. What if you ignored Buffett's interviews and just followed his trades? Let's run the numbers. If you followed Buffett's words, you held through 2023, through 2024, and got slammed in Q1 of 2025. Maybe you even bought the dip, thinking that's what Buffett would do. But if you followed Buffett's 13F filings, you'd have done something very different. You would have trimmed Apple in late 2023 before its 21% drawdown. You'd have exited banks before the wave of commercial real estate write-downs. You'd have gone heavy into cash when it was yielding 5% and your portfolio. It would have dodged the worst of the Q1 2025 crash. Let's be specific. The S&P 500 dropped nearly 18% in Q1 2025. Apple, down 21%. Bank ETFs, some lost 28%. Meanwhile, Berkshire Hathaway's NAV held steady. Why? Because nearly half the portfolio was in T-bills, while the market bled. Buffett's cash earned. And not just a little. That $382 billion in cash wasn't just idle, it was compounding at 4.852 in short-term treasuries. That's nearly $19 billion in risk-free interest income, while everyone else was losing their shirts. Now let's flip it. Imagine if every retail investor who listened to Buffett's buy and hold speeches had instead mirrored the actual filings. Just the top 10 trades. You don't need to guess. They're public. If you followed those exits, your portfolio in 2025 would have had less Apple exposure, 0 banks, 0 energy, 40% plus cash, less volatility, more optionality. And here's what most people still don't realize. Buffett isn't lying when he says buy and hold works, but what he doesn't say out loud. It works best when you're Buffett, when you buy at scale, when you negotiate your entry prices, when you have permanent capital, when you are the market, you can afford to sit through the storm. Retail can't. You've got mortgage payments, tuition, retirement goals. You don't get to wait 15 years for a drawdown to recover. So when Buffett says hold forever, and then sells 67% of his largest position right before a drawdown, that's not philosophy, that's strategy, that's defense. And it's time we start treating it like that. When a titan like Buffett quietly shifts hundreds of billions, he's not just moving money, he's redrawing the map. So who came out ahead? And who's still picking up the pieces? Let's start with the winners. First and foremost, Buffett himself. He didn't call a crash on TV. He didn't issue warnings. He just moved with discipline, sold Apple at strength, dumped banks before CRA exposure blew up, shifted to cash before yields peaked. He walked away from a vulnerable market with $382 billion in liquid assets and 0 blood on his balance sheet. Next, anyone watching the filings instead of the headlines. If you were following 13FS instead of YouTube advice videos, you had the clues, Apple trims, bank exits, cash builds. It was all there quarter after quarter. You didn't need a hot take. You needed a spreadsheet. Third winner. Cash-heavy investors, the folks who didn't chase every rally, didn't fall for by the dip bait, and didn't hold on to zombie stocks because of quote posters on Reddit. They didn't earn big returns, but they kept dry powder. And now, they've got options. Now let's talk about the losers. Top of the list. Retail investors clinging to the Buffett religion. You know, the type long-term indexers who thought buy and hold meant never adjusting anything. They stayed fully invested through Q1 2025. Their portfolios took a 20% hit. No hedge, no liquidity, just vibes and pain. And guess what? They thought Buffett was in it with them. Second loser. Financial influencers and advisors who kept parroting, Buffett says never sell. They kept retail investors overexposed to overvalued sectors, especially Apple, without ever checking what Buffett was actually doing. They took the message at face value and passed it on, blind leading the blind. Third, retirement age investors, people with 5 to 10 years before retirement who couldn't afford a major drawdown. Many of them were overweight tech, banks, or both. And many thought Buffett-style investing meant riding it out no matter what. That cost them dearly. But maybe the most ironic loser, Buffett's legacy. Because now there's a crack in the image. The man who became famous for patience timed his exits with surgical precision. The man who said, "Don't try to predict the market," predicted it perfectly. He played the game differently and didn't tell the crowd following him. And that betrayal, whether intentional or not, will ripple for years. Because for decades, Buffett was the safety blanket, the North Star, the reason people felt okay ignoring the noise. But in the end, he didn't just turn down the volume. He walked out of the room. Let's fast forward to now early 2026. Warren Buffett is no longer CEO. He officially stepped down January 1st. No fanfare, no final interview, no letter saying goodbye, just silence. He handed control to Greg Abel, left behind a fortress of cash, and quietly exited the game with $382 billion parked in short-term treasuries. And that pile of money, it's still sitting there. No big acquisitions, no equity buying spree, no by-the-dip move. Berkshire's cash is earning close to 5% risk-free while the broader market is still trying to regain its footing. Meanwhile, the S&P 500 is down nearly 11% year-over-year from the 2025 correction. Tech hasn't fully recovered. Banks are still under pressure. Consumer credit is starting to deteriorate, and layoffs in logistics and manufacturing are accelerating. Apple, still down over 16% from its peak. Regional banks, most haven't made new highs since early 2024. Even oil and energy, once a safe haven, have cooled. So while financial media keeps repeating that the worst is behind us, Buffett's actions say something very different. He doesn't believe it. His last move before retirement wasn't a bold bet. It was a retreat, not out of fear but out of discipline. And Greg Abel, he's holding the line. No major shifts in allocation, no new stock buying spree, just caution, restraint, liquidity. So what does that tell us? It tells us Buffett didn't retire at the peak of confidence. He left during a moment of high uncertainty and structured Berkshire to weather it with extreme conservatism. It tells us that cash isn't just a parking lot, it's a shield, a weapon, a statement, and it tells us this. The people who think Buffett is still playing the old by the dip game, they're not watching his actual playbook. They're watching his interviews from 2012. They're quoting shareholder letters from a decade ago. They're holding Apple like it's Coca-Cola, and they're missing the message screaming from his balance sheet. He's out, and he's staying out. So if you're still fully exposed to this market, no cash, no hedge, no flexibility, you're playing a game Buffett himself stepped away from. And whether you call that hypocrisy or just cold, hard discipline, it's still a warning, because when the man who told you not to time the market nails the timing, you better stop quoting the slogan and start reading the signals. So what do you do when the world's most famous long-term investor breaks his own rules? You don't panic, you recalibrate. Here are 3 steps to adjust your game without throwing out your principles. Step 1. Stop quoting, start tracking. Buffett's interviews are charming. His letters are legendary, but his 13F filings are the real story. Every quarter, Berkshire discloses exactly what it owns, what it bought, what it sold. No fluff, no spin. Set a calendar reminder. Read the filings. Look for trends, not just trades. If Buffett trims the same stock 2 or 3 quarters in a row, he is not rebalancing. He's exiting. Step 2. Treat cash as strategy, not failure. Most retail investors think holding cash is missing out, that it's lazy, weak, unproductive. But Buffett doesn't. He built a $382 billion war chest not as a bet against the market, but as a bet on future opportunity. You can do the same. Build up a 10-20 cash allocation. Keep it in high-yield money market funds. Let it earn while you wait, because when markets correct, and they will, cash buys freedom. It lets you play offense when others are forced to sell. Step 3. Separate the message from the messenger. Buffett isn't a saint. He's a strategist. Yes, he said buy and hold, but that was in an era of stable inflation, predictable rates, and cheap valuations. Today's environment is different. So if his actions don't match his words, don't call it betrayal. Call it adaptation. You should do the same. If your portfolio is overweight mega cap tech, overexposed to index funds, or stretched too thin chasing yield, it's not Buffett's fault. But now that you know better, it's your move, because the truth is this. Buffett didn't abandon buy and hold. He just realized that in 2026, buying nothing was the best hold. So the next time someone quotes him, ask, did you check what he's actually doing? Because be greedy when others are fearful sounds great, but right now, Buffett is holding cash, and he's not afraid. He's just waiting.